Right now, something strange is happening in the silver market. According to official prices, silver trades far below what many analysts, miners, and long-term investors believe it should be worth. Some independent models and physical market indicators suggest a value closer to $127 per ounce, yet the public price tells a very different story. So what's going on? Is silver really undervalued? Is the market broken? Or are we misunderstanding how silver is priced in the modern financial system? At the center of this mystery is a little-known but extremely powerful institution called the COMEX, the futures exchange that helps set global silver prices. In this documentary, we will calmly explore how silver prices are actually set, what the COMEX really is, and how it works, why paper prices and physical silver often diverge, what history tells us about price suppression claims, and what this all means for everyday investors. No hype, no panic, just facts, structure, and clarity. The COMEX, short for the Commodity Exchange, plays a central role in how silver prices are discovered. Yet very few people truly understand what it does. Most assume it is a marketplace where real silver bars change hands. That assumption is where confusion begins. The COMEX is primarily a futures exchange, meaning it trades promises, contracts that represent silver to be delivered at a later date, often months in the future. The hook is this: the global price of silver is not set by people buying metal, but by traders exchanging paper agreements. These futures contracts allow buyers and sellers to speculate on price movements without ever touching physical silver. In fact, the vast majority of contracts are never settled with real metal at all. They are closed out in cash before delivery. This system was designed to provide liquidity and stability for industries that rely on silver, from electronics to energy. On the surface, it works efficiently. Prices move smoothly, markets remain orderly. Volatility appears controlled. But beneath that stability lies a critical imbalance. The volume of paper contracts traded daily on the COMEX far exceeds the amount of physical silver available for delivery. This creates a pricing mechanism driven more by financial leverage than by actual supply and demand. When large institutions place massive buy or sell orders, prices can move sharply even though no physical silver has entered or left the market. The deeper hook is that price discovery becomes detached from reality. If silver is scarce in the physical world but abundant on paper, the market price reflects abundance, not shortage. This disconnect is not accidental. It is a structural feature of modern commodity markets. For decades, confidence in this system has kept it functioning. Participants trust that contracts can be settled, obligations can be met, and prices reflect fair value. The moment that trust is questioned, when too many participants care about delivery instead of cash, the foundation of the system becomes visible. Understanding the COMEX is not about believing in manipulation or dismissing markets entirely. It is about recognizing that the price of silver most people see is a financial signal, not a direct measure of the metal itself. One of the most misunderstood aspects of the silver market is the difference between paper silver and physical silver. On paper, silver appears abundant, liquid, and easily traded. In the real world, it is a tangible metal that must be mined, refined, transported, and stored. The hook lies in this contradiction. Two versions of silver exist at the same time, yet only one is scarce. Paper silver consists of futures contracts, options, exchange-traded products, and unallocated accounts. These instruments allow investors and institutions to gain exposure to silver's price without owning the metal itself. They are convenient, fast, and highly liquid. Physical silver, by contrast, exists as coins, bars, and industrial inventory. It cannot be created instantly. Every ounce requires time, energy, and cost to produce. This difference alone explains why the two markets can behave so differently. In paper markets, supply is flexible. Contracts can be written in large quantities, as long as there is confidence they will not all demand delivery at once. This flexibility keeps prices stable and predictable. In physical markets, supply is rigid. Mines cannot increase output overnight, and recycling only recovers a portion of what is consumed. When demand rises suddenly, shortages appear quickly. The hook becomes clear when the two systems diverge. During periods of high demand, coin dealers report empty shelves, rising premiums, and long delivery times, even while the official spot price remains calm. Buyers sense scarcity, yet prices do not respond as expected. This creates confusion and frustration, especially for those who assume the quoted price reflects real-world availability. This disconnect matters because pricing power resides where volume is highest. Paper silver trades in massive quantities, dwarfing physical transactions. As a result, price discovery is driven by financial activity rather than physical exchange. The system functions as long as trust remains intact. The risk emerges when confidence shifts, when participants begin to question whether paper claims truly represent accessible metal. At that point, the difference between owning silver on paper and holding it in hand becomes more than theoretical, it becomes decisive. Silver occupies a unique position in the global economy because it is both a monetary metal and a critical industrial resource. This dual role is often overlooked, yet it is central to understanding why silver's pricing behavior appears so disconnected from reality. The hook is that silver is not simply stored and admired like gold. It is actively consumed, used up in processes that rarely allow it to return to the market in meaningful quantities. Modern technology depends heavily on silver's physical properties. It is the most conductive metal for electricity and heat, making it essential for electronics, solar panels, electric vehicles, medical equipment, and advanced defense systems. Each device uses only a small amount, but across billions of products, the demand becomes enormous. Once silver is embedded in circuits or medical tools, recovery is often uneconomical, effectively removing that metal from circulation. At the same time, global mine production has struggled to keep pace. Silver mining is complex and capital-intensive, and much of the world's silver is produced as a byproduct of mining other metals, such as copper or lead. This limits how quickly supply can respond to rising demand. Even when prices increase, new silver does not suddenly appear. The pipeline from exploration to production can take years. The hook deepens when industrial demand collides with investment demand. In periods of economic uncertainty, silver attracts investors seeking tangible value. This creates competition between factories that need silver to operate and individuals who want to hold it as protection. Historically, such competition has driven prices higher as supply tightens, yet the expected price response has been muted. Despite record industrial usage and persistent supply constraints, silver prices remain restrained. This contradiction suggests that forces beyond physical supply and demand are influencing the market. When a metal that is essential, consumable, and increasingly scarce does not reflect those realities in its price, it raises fundamental questions about how that price is formed. Understanding silver's industrial role is not optional. It is key to recognizing why many believe the market signals no longer align with the physical world. Questions surrounding silver prices are not a recent development. They have surfaced repeatedly during periods of economic stress, monetary change, and market volatility. The hook is that nearly every major surge in interest toward silver has been followed by controversy, investigation, or sudden rule changes, patterns that suggest the metal has long occupied an uncomfortable position within the financial system. In the 1970s, rising inflation and weakening confidence in paper currencies pushed investors toward tangible assets. Silver prices began climbing rapidly as demand surged. By 1980, silver reached levels that shocked global markets. What followed was equally dramatic. Exchange rules were changed, margin requirements were raised sharply, and prices collapsed in a matter of days. For many participants, the episode raised a lasting question. Were markets protecting stability, or were they protecting the system itself? In the decades that followed, silver continued to attract scrutiny. Large financial institutions became dominant players in futures markets, capable of moving prices with significant leverage. Over time, regulators uncovered cases where traders used illegal tactics such as spoofing, placing large orders they never intended to execute in order to influence prices. Several major banks were fined, and traders were prosecuted. These were not minor infractions. They confirmed that price signals in silver markets had at times been deliberately distorted. The hook is not that manipulation exists. No market is entirely free of it, but that silver appears especially vulnerable due to its relatively small size and strategic importance. Compared to equities or currencies, silver is easier to influence with concentrated capital. Small shifts in sentiment or positioning can produce outsized effects. What history consistently shows is that silver price controversies tend to emerge when confidence in financial systems weakens. Each episode leaves behind tighter rules, quieter markets, and unresolved doubts. The metal continues to trade. Industries continue to rely on it, yet questions linger about whether its price reflects open discovery or managed outcomes. Understanding this historical context helps explain why modern skepticism toward silver pricing is not rooted in speculation alone, but in patterns that have repeated across generations. The idea that silver could be worth around $127 an ounce does not come from a single forecast or a dramatic prediction. It emerges from a collection of valuation models that look beyond day-to-day trading and focus on long-term monetary and physical realities. The hook is that none of these models rely on speculation. They rely on history, math, and comparison. One of the most widely cited approaches is inflation adjustment. Silver's nominal peak occurred in 1980 during a period of intense monetary stress. When that price is adjusted for decades of currency devaluation, the equivalent value today rises well above current market levels. This method does not assume silver must return to its old high, but it highlights how much purchasing power has been lost since then. Another framework is the gold-to-silver ratio. For centuries, this ratio averaged close to 15 ounces of silver for 1 ounce of gold. Today, that ratio is many times higher, implying that silver is historically cheap relative to gold. If the ratio were to normalize even partially, silver prices would need to rise significantly. The hook here is not prediction, but imbalance. Extreme ratios rarely persist indefinitely. There is also the issue of monetary expansion. Over the past 2 decades, global money supply has grown at an unprecedented pace. When compared to this expansion, silver's price appears disconnected from the scale of currency creation. Hard assets have historically acted as reference points during such periods, adjusting upward as paper money loses value. Mining economics add another layer. The cost to discover, develop, and operate silver mines has risen sharply due to energy costs, regulations, and declining ore quality. Replacement cost models suggest that prices below sustainable production levels cannot persist forever without supply consequences. None of these models claim certainty. Together, however, they form a consistent signal. The hook is that while markets can ignore fundamentals for long periods, they rarely do so forever. These valuations do not say what silver will do next week or next year. They simply suggest that the current price may reflect financial mechanics more than long-term economic reality. A critical pressure point in the silver market appears when futures contracts move closer to delivery. This is where the abstract world of paper promises intersects with the physical reality of metal. The hook is that most participants never intend to cross this line, yet the system depends on the assumption that they could. Each futures contract represents a specific amount of silver that can be delivered during a set month. As delivery approaches, traders must either close their positions or stand for delivery. Historically, only a small fraction choose the latter. This keeps the system running smoothly. But when economic uncertainty rises and trust in paper assets weakens, interest in actual delivery increases. The COMEX reports inventory in 2 broad categories: registered silver, which is available for delivery, and eligible silver, which meets standards but is not committed to fulfill contracts. The distinction matters. The hook emerges when the number of contracts demanding delivery begins to approach, or even exceed, the amount of registered silver. On paper, everything still appears orderly. In reality, the margin for error narrows. Over recent years, analysts have noted periods where open interest relative to available metal reached historically high levels. This does not guarantee a failure, but it does increase sensitivity. A small shift in behavior, more participants choosing metal over cash, can strain the system. To manage this risk, exchanges rely on incentives, rule adjustments, and cash settlement options. The deeper issue is confidence. Futures markets function because participants believe delivery will be honored if required. The moment that belief weakens, behavior changes. Traders become more cautious. Long holders become more insistent. Volatility increases, even without a physical shortage making headlines. The hook is subtle but powerful. The system is not designed to collapse. It is designed to discourage mass delivery. That design has worked for decades. But as more people question whether paper claims truly reflect accessible silver, attention shifts to inventories, delivery reports, and anomalies that once went unnoticed. In such an environment, even routine settlement cycles take on outsized significance, revealing how finely balanced the structure truly is. For most people, debates about futures contracts, inventories, and pricing mechanisms feel distant and abstract. The hook is that these systems quietly shape real-world outcomes, influencing what people pay, what they can access, and how financial security is preserved. Silver is not just a chart on a screen, it is a metal embedded in daily life and personal savings decisions. When official prices remain low while physical demand rises, ordinary buyers experience the tension firsthand. Coin shops report higher premiums over spot prices, delayed deliveries, and limited availability. An ounce of silver may be quoted at one price online, but acquiring it in reality often costs significantly more. This gap confuses newcomers and signals that the market price does not always reflect real conditions on the ground. For savers, silver has traditionally served as a form of long-term protection rather than a quick trade. People are drawn to it during periods of inflation, rising debt, and declining trust in institutions. The hook is that many are not trying to beat the market, they are trying to step outside of it. Physical silver represents something tangible in a financial world, increasingly defined by digits and promises. Industries feel the impact as well. Manufacturers that rely on silver face higher costs and supply uncertainty when availability tightens, regardless of what futures prices suggest. These pressures eventually filter down to consumers through higher prices for electronics, energy technologies, and medical equipment. The most important effect, however, is psychological. When individuals notice repeated mismatches between quoted prices and lived experience, confidence erodes. People begin asking different questions, not just about silver, but about how markets function more broadly. That shift in awareness matters. It changes behavior, encourages diversification, and pushes individuals to seek clarity rather than assumptions. The hook is not fear, but recognition. Understanding how silver markets operate allows people to make informed decisions without panic. It reframes silver from a speculative asset into a signal, one that reflects deeper stresses and adjustments within the global financial system. Let's summarize calmly. Silver prices are set mainly in paper markets. Physical and paper silver are not the same thing. Industrial demand is rising. Historical and inflation-based models suggest higher valuations. The COMEX prioritizes stability over scarcity. This does not guarantee silver will reach $127, but it explains why many believe today's price does not reflect reality. Understanding the structure matters more than believing any single number. If this documentary helped clarify the issue, like the video to support clear financial education. Comment below. Do you believe silver prices reflect reality, or are they artificially restrained? And subscribe for more calm, fact-based documentaries that explain complex financial systems in simple terms. Because in markets, understanding the rules is more valuable than reacting to the noise.